All right, let's dive right in. Today, we're going to pull back the curtain on financial charts. We're going to decode their secret language by getting a handle on one of the most crucial concepts in all of trading: support and resistance. Have you ever looked at a price chart and just seen, well, a bunch of random squiggly lines going up and down? It can look totally chaotic, even for people who've been at this for a while. But what if I told you that hidden inside that noise are patterns? Patterns that can actually give you a clue about where the market might go next. Because that's exactly what it is. It's a language, a story about a constant, epic battle between the buyers and the sellers. And the fundamental grammar of that language, the absolute building blocks, are support and resistance. So let's get right into the basics of this conflict, this tug of war between the buyers and sellers. First up, support. The easiest way to think about this is like a floor or a safety net underneath the price. As a stock or any asset falls, it gets cheaper, right? It becomes more of a bargain. At some point, enough buyers jump in thinking, hey, this is a great deal, and that wave of demand is strong enough to stop the price from falling any further. And on the flip side, you've got resistance. You can probably guess this is the exact opposite. It's a price ceiling. As the price goes up and up, sellers start to get tempted. They're thinking, wow, I've made a nice profit. Maybe it's time to cash out. Eventually, enough sellers decide to sell that they overwhelm the buyers, and that upward momentum just hits a wall. So this is what it really boils down to, the pure psychology of it. At support, demand is winning the fight. The buyers are in charge. At resistance, supply takes over, and the sellers are calling the shots. It's this constant tug of war, and these levels, these are the battle lines. Okay, so we get what they are, but that's only half the story. How in the world do you actually find these invisible floors and ceilings on a real chart? Well, this is where it becomes a little bit of an art and a little bit of a science. You've basically got two flavors here. First, you have static levels. Think of these as lines in the sand, fixed price points based on where the market turned in the past. They're great when a market is just bouncing around sideways. Then you have dynamic levels, which are cool because they actually move with the price. They're way more useful when the market is in a clear uptrend or downtrend. So let's start with the art part of the equation. This is the most common way to do it, and it's all about looking back at the chart's history to map out those really important psychological battlegrounds. It's really a simple three-step recipe. First, always start on a higher time frame, like the daily chart. Why? Because the levels you find there are much, much more significant. A lot more money has changed hands at those prices. Then, just scan the chart for the most obvious peaks and valleys, the major turning points. Finally, your job is to play connect the dots and draw a horizontal line that gets as many touches as possible. The magic number you're looking for is at least 3. Now, this is super, super important. You have to think of these levels as zones or areas, not as a perfect laser-thin line. Look at how the little wicks on these candles often poke through the level. That's the market testing the waters, feeling out the other side, even if the price ultimately closes back inside the zone. Okay, so that was the art. Now for the science. Static lines are fantastic, but what about when the market is really on the move, in a strong trend? You need levels that can keep up, that adapt in real time, and that's where dynamic indicators come into play. These are basically tools that do some of the heavy lifting for you, automatically creating an adaptive map of support and resistance that changes as new price info comes in. Things like moving averages can show you the underlying trend, while something like VWAP can give you a clue where the big institutions might be trading. All right, we can now find the battle lines on our chart. We've got our map. But how do traders actually use this to make decisions? Let's break down 3 of the most common strategies. First up, we have the most straightforward strategy, the bounce. This one is perfect for those markets that are just kind of stuck in the mud, moving sideways between a really clear floor and a really clear ceiling. And the logic is about as simple as it gets. Traders will look for opportunities to buy when the price comes down and bounces off that support floor, and look to sell when it goes up and gets rejected by that resistance ceiling. You can see here the price does this multiple times before it finally decides to break out. But, prices don't stay in a box forever. So what happens when the bounce doesn't happen? What happens when the price finally smashes right through that ceiling or crashes through the floor? That, my friends, is a breakout, and it can be a sign that a big, powerful new trend is just getting started. Now, breakouts are exciting, but they can also be traps. So a more patient, and some would say smarter, strategy is to wait for the retest. Instead of just jumping in the second the level breaks, you wait for the price to come back and test that same level from the other side. It's all about getting that extra confirmation. This brings us to one of the most beautiful and reliable concepts in technical analysis. It's called a role reversal. An old floor can become the new ceiling, and an old ceiling can become the new floor. It's an incredibly powerful signal. And this chart is a perfect example of the retest in action. See that? First, the price breaks down, clean through the support line, but then it rallies back up to basically kiss it goodbye from underneath. When it fails to get back above that line, that's your confirmation. The old support has officially become new resistance, and that could signal a much bigger move to the downside. Okay, before we wrap this up, I want to talk about one of the biggest myths out there, a huge misconception that gets a lot of new traders into a ton of trouble. You hear this all the time. The thinking goes, if a price keeps bouncing off a level over and over and over again, that level must be getting stronger each time. It must be more and more reliable. I mean, it makes sense, right? Nope. It is actually the exact opposite. I want you to think of a support or resistance level like a brick wall. Every single time the price slams into it, it's like taking a sledgehammer to that wall. It chips away at it, it absorbs a little more of the supply or demand that's holding it in place, so the more times that wall gets hit, the weaker it gets and the more likely it is to finally shatter. So there you have it. By understanding support and resistance, you've learned the basic grammar of the market's language. You can see the story playing out, you can see the battle lines, the areas of tension, and the potential turning points. That random noise isn't so random anymore, is it? Now you can read the story. The only question left is, what will you discover?